Welcome to Chapter 7. I hope that the general flow of these lectures is working for all of you as I try to find my groove going to an online platform. But high level, again, it's nice to start with the formulas that are most relevant from the formula sheet, a bit of theory, and then kind of a warm-up to the lecture, if you will, and then into the slides, and then some example problems will be the general kind of high-level overview of how I plan to structure everything. Chapter 7, my intro video that I trust you watched already, will cover some of the denser theory of the CAPM and the world of beta and how they relate to each other. So again, we're dealing with the CAPM in this chapter, which is the capital asset pricing model. And again, it's a very profound and dominant tool in the world of finance. So what we'll talk about is the model, the security market line, which we've talked about again with beta on this axis, and how to price securities and different types of CAPM. We will not talk too much about, quite frankly, and then we'll talk about liquidity. So again, it's a very powerful model. The book will talk about that. Over the long haul, again, markets are very efficient. You could actually argue even in the short term, they're very efficient. So there will be an equilibrium between the price of securities and their respective risk profiles as information becomes available. And again, that's a page out of market efficiency. But again, things should normalize that their price is commensurate with the risk profile. These are the two big names I am most familiar with, not to downplay Zlittner or Mawson, but definitely Markowitz and Sharp, along with probably, is it Miller and Modigliani, and Merton, Scholes, and Black from the Black-Scholes model. Some of those are the bigger names in finance, but Markowitz was all about the efficiency frontier, and Sharp for the Sharp ratio, Trainer for the Trainer ratio, which again, the Trainer ratio is my hint, slope of the security market line. So we try to optimize our portfolio. A bunch of securities, they have different correlations or covariances. We try to find the optimal mix to get an efficiency frontier. And then we mix in some sort of risk-free asset with that, optimal portfolio, P, and then maybe investor C chooses this portfolio. And again, that's assuming standard deviation. We want to get a nice steep cal. The steeper the cal, the better we are, because we get a better Sharp ratio. I wouldn't worry too much about the theory here of the market portfolio is the aggregation of all risky assets and it has the same weights. That might be theoretically true, but again, this portfolio is the market portfolio, but we've optimized the risk to get the highest point of tangency on the cal. So I wouldn't worry too much about that. This is kind of, again, going down the theoretical chute that all investors will hold the same portfolio, which is the market portfolio. That's that mix of all of the different securities. They claim an equal proportion. Again, don't think about it too much. Basically, the market portfolios, you own everything. And then again, we're going to mix in the risk-free eventually. And again, we're on the efficiency frontier, as we've discussed. The slope is, again, Sharp. Again, this is, so far we're going pretty quickly here because I was so thorough in the last couple of chapters. There we go. Again, the risk of the market, we get the return of the market, and this assumes that we have a weighted average of all of the investable securities in the universe of investable assets, and we get a capital market line, which again is a type of risk-reward ratio. You could also call it the cal. Again, they're kind of the same thing. Again, the big difference is, am I dealing with a sigma here or a beta? Then you start to really care if it's the security market line, which is beta, or the capital market line, which will be more sigma. And again, the cal is kind of a general term. The risk premium on different securities is always going to be a function of their individual contribution to that amount to the portfolio's risk. So if one individual stock carries a lot of risk with relation to the market, it'll of course have a higher risk profile. And again, it depends how they co-vary with each other or correlate to each other. Again, correlation being the rho, which again is a function of covariance, as we've discussed in detail. So they give an example here, and this is what I did in the warm-up video. So again, actually these slides might be quicker than I normally would intend because we were so thorough with the warm-up video where I went through a lot of this theory. And I know I drew out these formulas whereby we basically look at the weight. Yeah, I wouldn't worry too much about this. This, of course, just talks about the covariance of the individual security with the market. And then the risk-reward ratio would be the return that we expect ultimately. Again, capital R, friendly reminder, capital R is going to be excess, which means above the risk-free. So whatever return we're getting minus the risk-free, that's excess. So you can see ERB, lowercase r for B, minus the risk-free gives me my capital R. And this will be important in chapter 8 because they go back and forth with big R's and little r's to the point where it's almost frustrating. I know technically I should have written lowercase risk-free. If you see risk-free, capital R or lowercase r, don't worry at all. The key thing is the F for risk-free. It's the risk-free return. But if we're doing the return of the stock market or the index or the individual security B or RI or whatever it might be, then you want to start paying attention to if it's a lowercase r or a higher case r. And then divided by the risk profile, again, this is just theoretical stuff. We talked about this as well in quite a bit of detail, that, again, the excess return, again, because I'm minusing risk-free, divided by the variance of the market. That's also going to be very important. Yeah, I find these slides a little bit too theoretical, I have to admit. And the book would kind of echo this. It'll talk about it in more detail. Okay, yeah, we definitely talked about this in detail in my warm-up slides. This is the theoretical construct of how we get to the actual CAPM formula. So let's actually spend a little bit of time on this. So the starting point is kind of here, where, again, the excess return that investment B will do relative to its risk and its covariance with respect to the market, which again will be its risk contribution. Again, if we kind of think about here, the individual security's risk premium. Remember, risk premium is the excess return, the excess rate of return above the risk-free. It'll be a function of FX. It'll be a function of the covariance of how their returns relate to the general market. Again, covariance or correlation. So the risk premium is going to be commensurate with the risk. Higher risk, higher return. A bit more theory here. So it makes complete sense, talking about this area, that the expected return of investment B above the risk-free relative to its risk of investment B to the covariance with respect to the market will be equal to the excess return of the market, M for market, relative to the covariance of the market with the market, which is the same thing as the variance. So I just want to remind you here, if I did covariance of return of the market with return of the market, that is the exact same as saying the variance of the market, which is standard deviation squared of the market. Okay, so normally covariance, as you might recall, it would be like xi, yi. It would be two different data points. That's a y. But if I'm doing covariance of xx, I'm getting variance of x. Okay, so hopefully that makes sense. Covariance of market with itself is the variance of the market. Again, covariance is usually two different data points like we'd see here. So if I do covariance of X with itself, it's the same thing as doing variance. Because remember, with covariance, it looks kind of like this. I summate xi minus x bar times xi minus y bar divided by my n minus 1, for example. So again, if this was xi and I make this xi x bar, it's the same thing as doing all of this squared. Again, if you go back to chapter 4, we talk about that a little bit. So I digress. Investment B's excess return relative to its covariance with respect to the market. Again, markets are efficient, so that should be commensurate with the ratio of the excess returns of the market, again, the general market that the investor will hold, all equal investments in equal proportion to their market cap weight or what have you, divided by the variance of the market. Those ratios should be equal. Those ratios should be equal. So then again, I can simplify it a little bit. Again, capital R right here is excess return. So I removed my risk freeze. So excess return again is commensurate. So again, same idea, I get these ratios. In the next slide, and again, we talked about it in detail in the previous video, if I rearrange some of this stuff, namely, if I move this up here and do some math, that's what this next slide indicates. So I'm moving the covariance of investment B with the market up top to the numerator here. And again, my whole point in talking about this, and the book talking about this, and the slides talking about this, is again, classic academia. We're proving to you how we get to the CAPM. So again, like I said, I moved my covariance higher up. I moved it from here to here. That's what this did. And then again, the variance of the market was here. We just moved it over here. Friendly reminder, you might recall what beta is. What's beta? We talked about this. It's the covariance of the investment with the market divided by the variance of the market. Right? Not to be confused with correlation, where we do the covariance of I with M divided by sigma I, sigma M. You may recall that for correlation. That's why beta is kind of similar, except we're just taking it divided by the variance of the market. That's the big difference between beta and correlation. So follow these steps along. We get the excess return of the investment, covariance divided by the variance of the market. Looks just like this. And that's how we end up getting beta. And then again, here is the excess return, again, which they call an R there, capital R. And then we move this risk-free over. And basically we end up with this, which is CAPM. Do I think in an interview you'll have to explain all the steps of how you derive this? I personally don't. But if you're like my student from last year's Finance 412 who just apparently told me he's applying to Georgetown University in America for a master's degree in finance, knowing this will absolutely be helpful as he pursues a graduate degree, and who knows where he goes. He was very bright. He might go into academia and do a PhD. You know, the CFA might kind of talk about the derivation to this depth. But again, come exam time, it'll be more about the application of the CAPM than it will be the theoretical derivation of the CAPM. So that's how we get to the CAPM. So again, the CAPM is basically going to tell us the rate of return that I can expect on investment B is going to be the risk-free, because everyone gets the risk-free, plus the beta of investment B, which is the risk of investment B in the world of beta. We're not talking standard deviation. We're talking about how it moves with respect to the market, times multiplied by the excess return. So risk-free plus the beta, which tells me how sensitive it is to the market, times the excess returns. The excess rate of return above the risk-free of the market, by the way. So remember, beta is basically a measure of sensitivity of investment I, or in this case investment B, to the market. So in layman's terms, it's kind of like correlation again. Look how similar the formulas look. Quite similar. Again, the big difference, as you know, correlation is bounded by 1, -1. Beta is not. Beta can be greater than 1. But if I have a beta of 0.9 and the market goes up 10% and I hold, I don't know, Coca-Cola, it's not as volatile as the market. My Coca-Cola, Coke, will only go up 9% because the beta is 0.9. So again, very similar to correlation. That's the idea, the sensitivity to the movement of the market. And that's why I take beta and I multiply it by the excess return of the market. M for market. So whatever the movement of the market does times my beta, and again that's excess return of the market, times my beta plus the risk-free, because everybody gets their risk-free return, will be the projected expected value on investment B. That's the application of the CAPM. Weighted averages, very easy for a portfolio. And thankfully, betas of a portfolio, there's no fancy math. They're just weighted averages. And again, I did this in detail in my warm-up slides, but the expected return of the market, I believe the slides might come later, but I talked about how the beta of the market is equal to 1. Beta of the market is 1. And I showed the proof in my warm-up slides. So, now we're talking security market line. The SML. We're talking about an individual security. Certainly more applicable in the world of stocks. You don't have to know this nuance, but I am pretty sure it would only apply to stocks, not bonds. Certainly you could use some sort of construct, I suppose, of movements of the bond to the general bond market, and I guess it would kind of be like a beta, but certainly every time you hear beta, people think in the world of stock. So the security market line, remember the S is for security, it's also for single. Think single security. I want to know how to price an individual stock as it relates to the marketplace and know if it is appropriately priced. Is it too expensive or is it too cheap? Do I go long or do I go short? Or do I stay hold? The SML then becomes a linear line, just the way the CAL is, or the capital market line when we're using sigma, standard deviation. And again, the slope we get is going to be trainer, which is the excess return of the market divided by the beta. So trainer and Sharp, I highly encourage you to commit to memory. We did this in the theoretical side of things with the warm-up again, that we know the beta formula is this, and the slope is going to be trainer. So when we put the CAPM for the market, we end up getting what looks like this. And the covariance of the market with itself divided by the market, so make this I and M, and you get, of course, the variance of the market. Like I talked about earlier, covariance of X with X is the same as saying variance of X. So then I end up getting the variance of the market divided by the variance of the market. And of course, X over X is 1. Or sigma squared of M over sigma squared of M is 1. The beta of the market is always 1. The beta of the market is always 1. Okay, so here's a good little example. We talked about this also in the warm-up slide. People love hearing the word alpha. Remember, usually people think of alpha, and I see it with clients all the time. I see it with investment representatives for investment companies. They'll want to brag about their mutual fund or whatever, or the portfolio manager, and they'll almost always talk about alpha being outperformance. Meaning, my rate of return for investment I was greater than the rate of return for the market. Or as you'll hear often, benchmark. The benchmark is the TSX, the benchmark is the Nikkei in Japan, or the Dow, or whatever. Kind of like you bragging to your parents, if they paid your tuition, how are your grades? And you say, I got an A- compared to the benchmark of the average student. That benchmark is, I don't know, a B. So again, we'll use the market though, but again, a lot of investment professionals talk about the benchmark very regularly. Even if you're a bond fund manager, if your specialty is investment grade debt of corporations, not governments, you're going to try to find some sort of benchmark of all bonds in the world, which are investment grade corporate debts, right? Not sub-investment grade like sketchy bonds, not government bonds, not preferred shares, which are kind of like debt, you could say, sort of. We'll talk about preferred shares later. But the idea is that we're comparing the investment of an individual stock or fund or manager or whatever compared to the market or its benchmark. The other one you'll hear sometimes is the peer group. So this mutual fund did better than 80% of its peers. So it's a Canadian balanced fund. How did it compare to all of the peers in the universe of Canadian balanced funds? So there you go. So alpha is almost talked about in terms of outperformance for the return. But remember, what's the other big measure in finance we care about? It's not just rate of return, or E of R, it's also a measure of risk. So remember we talked about dominant portfolios? Remember, if here's some sort of risk metric, here's my risk, and here's my rate of return, if I'm supposed to be here on some sort of capital allocation line, again, I don't care if it's sigma or beta, but if I'm supposed to be here, but I get here, this difference is alpha. I'm getting a higher rate of return. But remember, the same definition of alpha is I go this way, I get the same rate of return as the benchmark, but what have I done to risk? Risk went lower. So again, the young university student, again, I'll pick on you poor males because you're more risk tolerant usually than females. Not always a good thing, by the way. I think I talked about how women are generally better at risk management. In fact, I see it all the time in personal finance. The woman, especially if they have kids, is worried about the estate planning and the insurance work and having 6 months of reserves as a slush fund in their portfolio. And the male's all worried about the best rate of returns possible in the portfolio. So again, that could be a good partnership, I suppose, but again, different investment characteristics across men and women sometimes. So the young male is excited that we're getting him alpha. He's getting a better rate of return for the same amount of risk, whether it's standard deviation or beta. The person like my dad is just happy that he could lower his risk profile and still get the same rate of return. But in his head, the first thing he's happy to hear is less risk. The young male is happy to hear better rate of return. So we'll go through an example in a moment where we are going through an example where a security with a beta of 1.2 is supposed to produce an expected return of 17 points. But the security market line, given the amount of beta it has, it's supposed to only do 14.8. So we're excited. We're going to make 17 minus 14.2. We're going to make 2.2% of alpha. So I would absolutely want to go long. I might even want to go and borrow or leverage or buy a call option. Who knows? Depends on my degree of risk tolerance and my degree of conviction in the mathematics behind this. So there we go. If the market is here, remember, what's the market beta? The market beta is always 1. Don't forget that. And this stock is a little bit higher risk. Maybe it is a Microsoft. Okay, don't quote me, but maybe Microsoft has a higher beta than the market, especially in its earlier years. So of course we expect a higher rate of return. And I think this is a typo. The SML says it should produce 14.8. So I believe they're trying to indicate, unless I'm missing something, this, for simplicity, let's call it 14.8. It's supposed to do 14.8 relative to what the SML says, but we predict, based on the investment analyst we hired, based on their earnings and etc., we expect the stock to be trading at such a price point, including dividends, that it will generate a return of 17% for the holding period we have. The holding period rate of return, you guys remember that. So I'm going to get alpha. So what's the reality? It's not perfect. The CAPM is not perfect, but it is one of the best tools out there. So I know the Graham McEwen textbook, I think even talked about a survey of investment professionals, and the vast majority still says they use CAPM as one of their main indicators in risk analysis and pricing securities. So again, a lot of this stuff kind of gets theoretical. We assume with CAPM that markets are very efficient. And there's a lot of evidence that markets are extremely efficient. That's why it's so hard to beat the street, over the long haul especially. If you luck out 1 or 2 years in a row, it could be probability of just luck. But the persistency of that is extremely unlikely. And that's the argument of just tracking the index and keeping your fees low. But there's always people out there trying to beat the market. And the irony is, a lot of people trying to beat the market is actually what makes them efficient. So if a stock is going to do really, really well and do better than it should based on the amount of risk, people trying to beat the market will discover that opportunity, and they'll put money towards that stock or bond or real estate. It could be any asset class. And they're going to bid the price of that security higher, right? Supply and demand, more money goes into that stock because people think it'll do really well. And let's say they're correct. What happens? The price goes up. If the price goes up, the expected return has to go down. And then it's priced to where it should be relative to the risk profile. And that's kind of the thesis behind market efficiency, which we'll talk about, I believe, in Chapter 9. So it assumes markets are efficient. And if markets are efficient, we get alpha of 0. Right back to this slide. If everyone buys this stock, its price is going to go up, so its returns are going to go down, which means the 17% comes back to earth. It comes back in line with the SML. That's market efficiency, and if markets are efficient, my alpha gets squeezed and it becomes 0. 0%. So if markets are efficient, alpha gets driven to 0. So we could test it, and indeed there's no shortage of papers. If you want to nerd out or you do a graduate degree, you could read some of the papers. What I liked about the CFA curriculum a lot, I'll have to admit, is it definitely keeps someone who enjoys finance, economics, accounting, and quantitative measures like statistics and econometrics. It keeps you excited and mentally stimulated. It's definitely a difficult exam. It's actually 3 exams. But as far as the academic literature goes, they don't make you read 40 papers the way a PhD student might have to. But they do kind of a Twitter version or an executive summary of the academic literature. So I always like the CFA for that. And as a practitioner in finance, I would say that when you deal with a client, they just want the executive summary. And that's a big thing, is even if you're really, really smart, can you translate that information to your boss or your client or whoever in your life in a way they understand and in an executive fashion? So again, the CFA is designed for practitioners, so they'll talk about the literature, but they'll kind of cut to the chase and say, this is the bottom line, depending which paper you read, blah, 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 blah. This is the bottom line, and this is how you apply it. So, okay, again, the other interesting thing is proxies for the market. Remember, the market portfolio is a theoretical construct. We can't actually identify every single investable security with perfect precision. We can get pretty close, but in the purest form, it is a theoretical construct. And as Keynes says, you guys might remember Keynes, the economist. I believe he's what you call a monetarist, I think. Monetarist. Maybe not a monetarist. I might take that out. But he is not like Adam Smith, where he believes in the invisible hand. supply and demand, keep the government out of it. Keynes is much more a supporter of, you know, you'll hear the term Keynesian economics. Sorry, monetarist, apologies, that was Friedman. Friedman was all about playing with money supply and that sort of thing. But Keynes was, he was open to government intervention. But my point in bringing up Keynes is he called it, I'm pretty sure this is his quote, the animal spirits. That us people in the marketplace, we are basically a bunch of monkeys running around. So greed and fear and anger and optimism and pessimism, they will drive the market sometimes. Another famous Keynes quote is, markets can stay irrational longer than you can stay solvent. That's probably one of my favorites. So yeah, you can borrow and buy stocks, and you hope stocks do 8%. And you're going to borrow at 3%, is my loan, 3%. So I'm going to make a spread of 5%. But markets could stay irrational for 20 years. And that's longer than I can stay solvent and pay my interest on my loan. That's kind of the idea behind that. So it's a classic Keynes quote. And only because quotes are so much fun in finance. My other favorite one of Keynes was, in the long run, we're all dead. So it's funny, in economics, we talk about the short run and the long run supply and demand effects and inflationary effects and blah, 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 and long-term unemployment and frictional unemployment and structural unemployment and all these things. But he just says, in the long run, we're all dead. So it's kind of funny when you talk about long time frames, over 20 years, over 50 years, over 100 years. But again, will you even live that long? I digress. Because of the animal spirits, it's no surprise that a model that's driven on mathematics, covariance, correlations, regression analysis does not work perfectly. If it worked perfectly, that's just not real life. That's like a biologist building a model on the reproduction of, I don't know, polar bears in the Arctic or whatever, and their model's not going to be perfect. It might be close, it might be the best tool they have, but it's not going to be perfect. So, nonetheless, that's why it says it does still remain one of the best tools available and accepted. Extensions, I don't want you to worry about this too much at all, actually. Same thing here. This is getting a little bit complicated. So I'm going to skip all of these things. So save your trouble for the textbook. Maybe skim it if you really enjoy the content, but I wouldn't worry too much. Same thing with Black's zero beta model. I also don't want you to worry too much about this. So we can disregard that. This is the same. Okay, liquidity though. Liquidity is going to be important. We talked about this in my introductory notes, that when something is hard to sell, so if it's hard to sell, it might be a small cap stock because there's not very much trading volume. If the trading volume is pretty low, you end up getting what's called a bid-ask spread that widens. So if trading volume is low, there's not that many people buying and selling. Supply and demand is pretty low. We're not trading Royal Bank stock. We're trading a little tiny company worth $80 million market cap. And again, market cap, you'll hear market capitalization. Market capitalization is just the number of common shares times the market price. So if you hear market cap, it's just the value of the equity of the company on the stock market. It's not the equity of the balance sheet. That's different. That's assets minus liabilities. But market cap is the equity value on the index, on the stock market. So if it's a small market cap, like I said, $80 million corporation, that's definitely small cap, maybe even micro cap. There's not going to be tons of trading volume. So you're going to have a bid-ask spread that's wider versus trading Royal Bank stock or JP Morgan in the US or some massive Chinese manufacturer on the Chinese market. Its bid-ask spreads are going to be really thin because there's so much trading volume. So there's a negative relationship. If there's low trading volume, we end up with a bigger bid-ask spread. And what's the bid-ask spread? Again, it's what the brokerage or the dealer, okay, the dealer of the securities, kind of think like the market, they're going to ask for a wider spread between the selling price and the buying price of the security. And that's kind of their profit margin, if you want to call it that. So if it's not traded very much, for example, real estate's a good example, small cap stocks, you could say derivatives to a degree. But in the world of stocks, I would think of small cap stocks. The other one would be bonds. Bonds are actually still kind of old school, where you call up almost a dealer broker type environment, while stocks trade much more with much greater velocity than bonds. So bonds can have liquidity issues. In the peak of COVID crisis, bonds were quite difficult to trade. That's part of the reason the prices got all wonky, amongst many other things. So the tighter, the lower the trading volume and the harder something is to buy and sell results in a greater liquidity or illiquidity premium, because it's going to be more costly to trade it. It's more costly to trade it, higher costs. So then the discount, which means the price will go down, which means my expected return will go up. It's going to earn me a premium. So the idea is, if I'm going to buy an apartment building or a stock that's hard to sell, I better get a good deal on it, which is my discount, resulting in a premium of a rate of return because it's hard to trade. So, interestingly, if let's say Royal Bank was here, the bid-ask spread, very narrow, very tight spread. RBC, tons of trading volume. What's my rate of return? Whatever, I don't know, 0.3% rate of return per month. But then I go to my friend's dad's company in Calgary, little tiny junior oil company in Calgary, and it's worth $80 million, especially with oil the way it is right now. And I want to try to sell it. I'm paying a really high bid-ask spread. So as a result, I get a higher rate of return because I have to be compensated for that risk. So what this academic paper did, have I read it? I have not, but I suspect they did a bunch of regression analysis. Again, that's the power of regression. And again, I encourage you to do Econ 299 and possibly 399 if you have the time. They probably did a bunch of regression, and the idea is they accounted for all kinds of factors or functions. They accounted for a whole bunch of things, and they just tried to extract these two single variables, bid-ask spread and average monthly return. So they didn't care if you were a consumer staple, energy, finance, technology, pharmaceutical. They didn't care which industry you were in. They would have accounted for that. And they would have controlled for all those factors in their analysis. You'll see this a lot in medicine and epidemiology. You know, they'll say people who sit at their desks all day have all kinds of health issues, and they say sitting is the new smoking, which is why you see people on standing desks now, stuff like that. And they'll try to control for, even if you go to the gym, 3 times a week, they'll try to control for that factor. And there's still evidence that people that sit at their desk all day have other greater health issues than people that are on their feet all day, like someone who works at Safeway, or a welder, or a plumber, or whatever, even just moving around. So you'll see control factors all the times in regression analysis across all kinds of natural sciences, the humanities, finance, economics. So that's what I suspect they did in this paper. The takeaway, though, is if it's more liquid, you get lower bid-ask spreads, and you'll get a lower rate of return, because you're not going to be compensated for illiquidity. But if you're illiquid, you then get compensated for that, and you get a premium. You're going to generate a premium because the bid-ask spread is so high, because every time you have to buy and sell, you pay a pretty nasty spread. So liquidity doesn't seem like a big deal until it is. It's kind of like how we talked about Sharp. And I said Sharp is a great, powerful tool, but what about Sortino? In Sortino, you might recall, we divide the excess returns, capital R, by the downside deviation. Sigma, with a little negative there, means downside deviation. It was also called lower partial standard deviation. Hopefully that rings a bell. If you don't remember that, it's because you forgot or you didn't listen to the earlier videos, I think chapter 4 stuff. Why am I bringing that up again? Because Sharp divides the excess return by the total sigma. And again, clients don't care about standard deviation on the upside. On the upside, if things go really high, your standard deviation technically goes up because you have a broader range in your data. But again, when things go up, clients are always happy. So Sortino said, why don't we just focus on the downside? The downside of the standard deviation. Everyone's happy here. Everyone's happy. That's a happy face. But they're sad here. So Sortino says, let's just focus on the downside of the bell curve. So it's kind of like saying no one cares about standard deviation until things start going down. Then they really care what's the sigma. Same thing with liquidity. We could tell someone this oil company has a really high bid-ask spread, but they may not care when oil is booming. But when they have to get out, because oil is going to go downhill because Russia and OPEC and whatever and Venezuela are ganging up on Canada and the US or whatever, all of a sudden then you say, holy crap, liquidity matters. And it can dry up in a crisis because everyone wants to get out. There's not enough supply of people wanting to buy the security. The dealers get squeezed. They don't know what to do. And either it's hard to get out and or you pay a crazy bid-ask spread. Real estate's a really good example of that, especially in a depressed environment and especially if it's a unique asset class, like a warehouse or a high-rise or a really beautiful home. The more unique it is, the harder it will be to sell. And again, the other thing too is what we called contagion. That says contagion. Contagion. So the idea is just things are spreading. So in liquidity in one stock decreases, that's my one oil stock. It might decrease in my other oil stocks or even my other retail stocks or financial stocks, or who knows, it might be at all my securities now. Everything, you know, in a time of crisis, often correlations go to 1. Again, you could do a graduate class on just that statement and look at all different kinds of asset classes, but when things get really nasty, a lot of things go bad at the same time. So all of a sudden, liquidity dries up and it might be hitting all of my asset classes at the same time. So then we have this concept of a liquidity beta, where the beta tries to capture liquidity premiums. Again, like I said, all tradable assets, the market portfolio is kind of a theoretical construct because we can't observe every single stock price at the exact same moment in the entire world. So we try to get as close as we can using fancy math. We'll try to do a single index CAPM. The book might talk about, I'm not sure if it's in here, the CAPM. Again, that's something the CFA will talk about briefly. There's different versions of it out there, I guess. Kind of the way Sharp and Sortino use standard deviation, but in a different way. Again, most investors do not beat the index. It's extremely tough to do with any kind of persistency. And that's why alpha tends to go to 0 over the long haul. And if you're having fees in your portfolio, you end up with negative alpha because you're paying the fee. And again, clients of mine know this, but they still hire us to manage their money. And yes, we're compensated to do that. So is the fund company or the index manager or whatever. But sometimes clients just want the service done for them. So again, it's more important to save and build a good financial plan. But if you're going to do it yourself, there's a strong argument, of course, for index funds and ETFs. Here we go. There's been a ton of literature on this about mutual funds and active investing. active investing is the idea of trying to outbeat the market portfolio. So you're choosing stocks and bonds that are different than the index or the market portfolio in an effort to outperform. And you can see here's a histogram. The vast majority of alpha is right around 0, which tells you that a lot of smart people usually don't outperform the market. Some do, not that many, and a lot don't, and they produce negative alpha. So in these cases, you're better off just holding the index. And the literature says that even if you held one of these guys, in 5 years, they'll probably end up here or here. The persistency ratio is extremely difficult to maintain, especially in really robust markets like the S&P or really established markets that have a lot of trading activity. It's really, really tough to beat the market. Don't quote me on this statistic, but it was something like the average blue chip stock. By the way, a blue chip stock is usually large. It usually pays dividends, not always. It usually has a bunch of history. It's been around for at least 5-10 years or longer typically. It's usually, like I said, large cap. There's about 2,000 analysts at any given moment analyzing the average blue chip stock. So how the heck are you and I supposed to know something they don't? And they likely work for a massive institutional investor where they have tons of resources, tons of research, and they're getting extremely good information way faster than you and I are. And that's why it's so hard to beat the street. So there you go. That is it for chapter 7. Then we'll do some example problems.